Welcome to the Moving Markets podcast on Tuesday, the 24th of March, with me, Bernadette, and Anderko. I'm looking forward to catching up on the latest financial markets news with Julius Baer's head of product and investment content, Roman Canziani, this morning. And then we're going to be joined by our head of next generation research, Carsten Menke, to talk about something else that's been in the news recently, namely Germany's infrastructure spending spree, after not one but two economic research institutes claimed that the money isn't being spent as intended. So stay tuned for that. But first, though, let's catch up with the main news from the last 24 hours. Good morning to you, Roman.
Good morning, Bernadette.
So what a 24 hours it's been for global markets, Roman. We've seen dramatic swings fueled by escalating and then seemingly de-escalating tensions in the Middle East. Why don't we start with equities? There was a pretty substantial bounce back yesterday, particularly in Europe and the US, after President Trump signaled a pause in planned military action. Perhaps you could elaborate on that for us.
Yes, certainly. Well, it is probably a slight understatement to say that the market reacted very positively to those comments. The Stock 600 reversed steep early Monday morning losses to finish up 0.6%, and we saw similar gains across the board in the US with the Nasdaq, Dow, and the S&P 500 all climbing significantly. Investors essentially priced in a reduced probability of immediate large-scale conflict. That said, it is important to remember the Stock 600 remains dangerously close to a correction, down around 9% from its February highs. So some technical analysts remain cautious and say that yesterday's recovery isn't necessarily indicative of underlying strength.
Yeah, that's an interesting point. And what about the impact on fixed income, Roman? Government bonds, and especially US Treasury bonds, traded sharply higher.
Yes, Treasuries really moved. The two-year yield fell substantially, as much as 21 basis points at one point, as the threat of military action receded. Traders quickly scaled back expectations for Federal Reserve tightening. Last week, concerns about oil-driven inflation were pushing towards anticipating rate hikes, but yesterday the mood changed again. Now, no rate action is expected until the end of this year. It just highlights how sensitive markets are to any signal regarding conflict resolution.
All right, and speaking of oil, that's been a huge driver of the narrative. We saw some truly massive intraday swings, didn't we?
Exactly. Brent crude plummeted nearly 9% at one point after Trump's announcement. It was one of the largest intraday drops on the record. He specifically mentioned wanting to increase oil supply to bring prices down. However, analysts are rightly pointing out that uncertainty persists. Even if negotiations proceed, normalizing energy flows will take time. Overnight, we've seen oil rebounding, with Brent jumping over 3% as reports suggest Gulf states might join efforts against Iran. This is also cited as a reason why two-year US Treasuries trade 5 basis points higher again this morning.
And I think we also have to quickly touch on gold, don't we? So that the precious metal, often considered a safe haven, behaved unusually, didn't it?
Very unusual. Instead of acting as a safe haven, gold initially fell along with oil and risk assets yesterday morning before the massive turnaround across all asset classes. I read several comments saying that this indicates how crowded the gold as safe haven trade has become. Facing potential central bank reactions and forced selling, traders exhibited hurting behavior, and it seems investors were prioritizing raising cash amidst the turmoil across financial markets. This morning, spot gold is down about 0.5% compared with yesterday's close, trading at $4,420 an ounce, reflecting continued uncertainty and fragile sentiment.
All right, then on another note, Roman, we've had some interesting company-specific news. I understand Telecom Italia and Delivery Hero were in the spotlight here in Europe.
Indeed, Telecom Italia saw a jump of almost 5% after Poste Italiane launched a sizable acquisition offer. Conversely, Poste Italiane's shares dipped roughly 7% on the news. Meanwhile, Delivery Hero benefited from the sale of its Taiwan unit to Grab, resulting in its shares trading up almost 8%. And finally, airlines such as Delta, United, American, Air France, and Lufthansa, as well as cruise stocks, too gained ground as oil prices decreased.
Okay, then amidst all this news about the Middle East conflict, there were also some interesting economic data points in the last 24 hours. What's the story with consumer confidence in the Eurozone?
Unfortunately, it's weakening. Consumer confidence fell sharply in March, reaching its lowest level since late 2023. The war in the Middle East and the surging energy prices are clearly weighing heavily on sentiment. Economists are warning that this could lead to contracting household spending and potentially stagnant GDP growth over the next couple of quarters.
All right, and finally, any noteworthy developments elsewhere?
Well, yes, the EU and Australia finalized a free trade agreement overnight, strengthening ties and promoting a rules-based international order. Looking ahead, today we have flash PMI data coming out for several major economies, which will provide a crucial snapshot of current economic activity. Plus, we'll be keeping a close eye on comments from several ECB policymakers. And finally, a quick look at the equity futures market. Well, they are slightly in the red, so hold tight for a slightly weaker opening in the US this afternoon. That's it from me.
Great. Thanks very much for the news update this morning, Roman.
Always a pleasure. Thank you very much, Bernadette.
And now it's time to talk to Carsten. Good morning to you.
Hello, Bernadette. Good morning.
So let's talk about what's been hitting the headlines in Germany, infrastructure spending. This really moved into focus for financial markets last year when the new government announced the creation of a special infrastructure fund. But now it seems there's some doubts about whether the money's actually being spent as advertised, so to speak.
Indeed. So these doubts have been raised last week after two economic research institutes claimed that a large chunk of the special infrastructure fund has not been used as intended in 2025. It was spent on old rather than new projects, helping the government to fill holes in its budget. And as an overall result, infrastructure spending or infrastructure investments were down compared to 2024, which of course was in contrast to expectations. Complicating matters, the institutes also identified issues ranging from the definition of infrastructure investments to the calculation of the investment share and also the availability of data.
So what's your take on these claims?
Well, firstly, I think, and this is very unsurprising, they point to persistent budgetary constraints in Germany despite these special funds. Second, they once more show how important the earmarking of infrastructure investments is as part of the budgeting process. So if the money is set aside right from the start, say for roads and railways, then these issues should not arise. And that's what we see in other countries, for example. Third, we believe, and this is most important, I think, we believe it is too early to come to a final conclusion about Germany's infrastructure spending spree. The debt issuance of the special fund only started in October 2025. So due to projecting and planning, there is a significant time lag between the investment intention and the implementation. So we should give the German government some more time, I believe. The risk of dilution of the special fund remains, I think, in particular considering the large sums involved. So a critical outside perspective as provided by these research institutes is both welcome and needed, I would say. And this should help ensure better tracking of the spending of the special fund.
All right. If you look at data from the construction industry, is there evidence that activity is picking up?
Data from the German construction industry is painting a bit of a mixed picture. So there are many indicators available, and I guess depending on what message you want to convey, you pick either one or the other. So business expectations have rebounded quite markedly after the announcement of the special fund, but momentum has been fading lately. Capacity utilization has not picked up, rather to the contrary, and also construction orders are showing signs of softness more recently. But this is a very noisy series, so they could pick up again quite easily.
Okay, a noisy series, but that doesn't sound too positive, Carsten.
No, I think it's more of a mixed picture, but we still give Germany the benefit of doubt, expecting a pickup in activity as the year progresses. And in terms of investment applications, we did not expect a big boost for the construction industry anyway. So this news does not impact our constructive view on the buildings and infrastructure theme.
Carsten, very interesting. Thank you very much for joining us today and talking about something completely different for a change.
Thanks for having me. Bye-bye.
Well, that's it for today. This podcast. Thank you all for listening. And of course, thanks to Roman and Carsten for their briefings today. Please do tune in again tomorrow when Helen Freer will be back, hosting more of our experts to discuss what's moving markets. So don't miss that. Meanwhile, good luck today and goodbye for now.
The information and opinions expressed in this podcast constitute marketing material and are not the result of independent financial or investment research. Please refer to www.juliusbaer.com/legal/podcasts for further other important legal information.